Okay. How are we all doing? Let me just reduce this down and we will get started in just a moment. But how is everyone? Obviously, as you know, today is pretty big. Today we do have the Fed meeting. Now we'll have a little discussion about that. We'll have a potential idea potentially, but you got to remember that these meetings are always very, very difficult to predict in terms of how the markets are going to react. So generally what you want to be doing is waiting for the meeting to happen, assess it and think, what does this mean? And then create trade ideas or understand that maybe this now means we now need to go long, we now need to go short, maybe we don't need to trade anything. It's always best to wait for an event to happen and then assess it accordingly. So let me just sort out something first before I share my screen. But just let me know in the chat, what do you feel is going to happen today in regards to the market and what we all think about, and I'll discuss as well. I want this to be like an open discussion where we'll talk about what potential markets reactions could happen and how we can navigate, shall we say, through. So let me just sort out something quickly before we get into it. Let me see, where is it? I think it's this one. Nope. There we go. Okay, cool. So I'll sort something out in just a moment. But let's jump straight through into the calendar. And we'll have a little discussion about what's happened so far this week. And of course, how do we, what's the word I'm looking for? Some potential trade ideas. Some of the trades we spoke about last week has actually moved quite nicely in our favor. Stuff like GA, for example, NU. So they've done pretty well, right? And for those who know me, and for those who've been following me for a few years, knows that I prefer to take quality over quantity, right? I don't want to take those trades where I'm on the charts every single day. That's just unnecessary for me, in my opinion, in terms of my strategy, right? So we'll sort of potentially find some other good trades as well today. So let me just quickly change my screen and we'll have a little look at what we've got going on. So, apologies, let me just sort something out. Okay, and then what I'm going to do is expand this out. Okay, this one. I'm just sorting something out very, very, very quickly, and then we'll get straight into it. Okay, perfect, right. Lastly, just give me 2 more seconds. And there we go, perfect. So, hey, apologies about that. Right, let's get straight into it. So let's just have a little look, see what people are saying. Let's hear about fundamentals before the FOMC. We shall do that, no problem. Will the Fed be dovish later on? How many cuts can we expect next year? That is the question. And how do we understand, right, what is going to happen next year? Because right now, what the Fed does today, if they are pretty likely to cut, markets are not going to move on that, are they? Right? The markets only care about new things, right? If we have already seen a rate cut or the markets are already expecting it, it's no longer new news, is it? So in the eyes of the market, they want to see what is new. What is it something that we haven't expected? Markets will trade on what that assumption is. So we'll have a little chat about that, about dovish. How many rate cuts can we expect next year? The best way to look at it is look at the dot plot. And the dot plot is a quarterly release. It should be released today. And that gives us a guidance on what does the Fed expect for next year. And that's kind of what the markets will gauge on whether or not they have overly priced, underpriced, or they are perfectly priced. If they're perfectly priced, you're probably not going to see much movement. It'll be then what Powell says will drive what the dollar does. If they are underpriced, the amount of rate cuts, i.e. let's say the markets expect 2, but the Fed actually says, you know what, we expect 3, well then the markets are underpriced that expectation and you see a weaker dollar. you actually see very good equity move as well. So we're just going to have to see what the dot plot says, but that's a good way to understand how many cuts are expected. Let me see what else, double check. Why is it about expectations? You always have to be, markets move on future expectations, right? You can't trade what's already known because that's already in the price. It's known as being priced in. You might have heard about it. Buying the rumor, selling the fact. That's being priced in, right? Markets have already traded a weaker dollar in anticipation of a rate cut in December. So them cutting is no longer going to be new because it's already been traded. What we have to think is what's happening after December. And that's where you trade it to. If it says that there's going to be less rate cuts, then you buy the dollar. Not obviously on the meeting. You wait for price action to do its thing. Then you wait for the pullback. But markets need new things to trade. They can't continue to trade old news. That's a way of looking at it. So let's have a little look as to what we have had so far this week. So let's quickly have a little check on the calendar. Now, Monday was pretty quiet. We didn't really have too much. Centix investor confidence for euro can move it sometimes, but generally that should increase over time, to be fair, especially as German fiscal spending comes through into place. RBA this morning, yesterday morning, sorry, they came in at 3.6%. Now, if we have a little look at AUD USD, which we looked at this region last week. We've had some nice price action so far. If we drop to the 1 hour, but we'll have a little look at all this later. And then we've seen that breaker structure occur, right? So that's kind of like a textbook, what we always speak about in these coming down into a demand zone, wait for a breaker structure out of the region or a breaker structure around that region. It doesn't have to be outside the box. As long as we see a breaker structure, then we get in. It's kind of like a nice, very nice textbook move there. But if we look at a RBA, or what they did, which is this bullish candle here in early hours of the morning, of course, UK time, what we saw was, oh, they held interest rates as largely expected. Why did the AUD strengthen? Can anybody let me know why you believe that is the case? Why do you think, or why did we see a stronger AUD? Now, it's not about the rate, them holding rates. Remember, markets already know this. They've already traded the AUD. It's about what's mentioned is what strengthened the AUD, and it should strengthen the AUD in the future as well, right? Because now what markets are going to think is, okay, if the RBA was quite hawkish, meaning they pretty much said they're not going to cut anymore, the AUD is going to do very well against currencies or central banks that do want to cut, like the Fed. So there's divergence, right? You always want to be trading divergence. You want to be trading those who are quite hawkish, and you want to be buying those, versus selling those who are dovish, which could be happening from the Fed today. We'll just have to see what the dot plot on what Powell says at 7 o'clock UK time. So that could be a good AUD USD long in the future. You're trading what the future is expecting and what we anticipate for the future. So they pretty much reiterated that they're no longer going to cut. They actually expect potentially a rate hikes next year, which is kind of surprising, but markets are trading that anticipation. And that's what we're seeing. Then UEDA. The yen has actually surprisingly weakened a lot. And I think there's due to a couple of things, to be honest. We have seen a little bit of stronger dollar so far this week. From my perspective, yeah, I think it's mostly the dollar front, to be honest. UEDA was quite hawkish anyway, and that did strengthen the yen. But I don't think we've seen too much else from that. Jolt's job openings. Now, Jolt's was actually pretty good. The reason Jolt's is not too big of an impact is because it's quite volatile. Now, Jolt's job openings is something similar to, if you live in the UK, you have Indeed, the website Indeed, right? It's something similar to that, where if the employee, or the employer, sorry, doesn't remove the job opening, then it is going to skew the data, right? That's why people don't really look at Jolt's job openings too much, because it is quite skewed sometimes, where the employer might not take the job off the opening, or like on the website, and it actually says that there's more jobs than there actually are. As you can kind of see why, it can skew the data. So people do tend to focus a bit more on like ADP, which as you can see, we saw NFP, unemployment rate, big sets of actual data, shall we say. So yeah, ADP was actually kind of okay, 4.8k. Then obviously today we did have the Bank of Canada. We'll kind of potentially discuss that a bit later. Employment cost index, not really a market driver. The reason for that is because this is inflationary. Markets care more about employment data just because we haven't had that for a while and it's starting to come through now. The reason why they don't care too much about this or inflationary data is because during a lot of the lockdown, we already had a lot of inflation data. It came out throughout the lockdown. So it wasn't exactly delayed, shall we say, but employment data was delayed. So employment cost index is basically how much it costs to bring on labor, to bring on employment. And if that rises, for example, let's say it goes higher, then in terms of context, in market context, and we are seeing, let's say, stronger inflation, because obviously context is important, it could mean that the companies might have to adjust their either spending, maybe they'll have to raise their prices, and that can create inflation. So obviously in the context of where we're at right now, this is a good sign that it's actually a little bit cheaper to bring on people, which is good news for inflation to come lower. Then FMC today. Now, if I show you on Bloomberg, right, there's a good, if I go to the US section, there's a good thing that always comes out. And let me just refresh. Perfect. And obviously during the Fed meeting, there'll be a live thing at the top. And what I generally do is click on that. Let's say this is the live, right? And then read through as it comes through live. But if you haven't got Bloomberg, that's also okay. You can use something like Reuters, which is up here. Reuters is a good free website and they will generally have everything you need on there. But if you want to use the Fed website, you can also do that. And what you want to be doing is looking at economic projections, because this is quarterly data, right? So obviously the last one we had was September. So what we want to do is if we click latest release, it will bring us onto the Fed website. We then go to September, and in projection materials, what you want to be doing is you click in PDF. I don't know what HTML does. Oh, it opens it up in here. That's fine. I'll open up in a PDF just because that's what I generally do. Open it up in a PDF, and then it'll bring up something like this. And what we want to be doing, there we go. Sort of bugged out a little bit then. What we want to be doing, right, is then when December comes out, because this is September's, when December comes out, just scroll down a little bit to this, which is the dot plot. And what you want to be doing is comparing, are the dots, basically each one of these dots are Fed members, right? What they have expected. Doesn't necessarily determine who expected it, but they're basically members of the Fed who are anticipating rate hikes or rate cuts, right? Or holds. And what we want to be doing is comparing what does 2026 and a little bit of 2027, have they for December shifted lower or higher or stayed the same? Likely you'll see some shifts, but if 2026 dots have shifted lower, this is September, so when December's come out, just literally get it up in another tab and compare it. If they've shifted lower, can anybody tell me what that means for 2026? Does anybody know what that would mean? Can you, RBA we've just spoken about, what does the new chairman of the Fed and does it affect? Good question. So the likelihood is meant to be Hassett, and, or Polymarket suggests it anyway. And Hassett is known to be, or is expected to be known as a dovish member. Now think about it from a perspective of Trump. Trump is not going to bring on a Fed chairman who is going to want to hold rates, right? The whole premise of what Trump wants to do is cut. So he's not likely to bring on anybody that is going to want to not cut. So the likelihood of a dovish Hassett is relatively high. As a result, what does that mean? Maybe we see more rate cuts next year. What is that? How do you trade that? Because what we're not so much interested in like the theory or what it says in the textbook. We're more so interested in how can we actually trade it, and how we can actually trade it is we remain bearish the dollar on the premise that more rate cuts are going to happen. Now, there are some gray swan events. I just want to see if I can open up that Mizuho article from a very, very good trader called Jordan Rochester. And he did make a good article on that. Let me just, I think I downloaded it the other day. Let me just double check. It might be this one. Is it this one? Gray Swan, there we go. So events wise, you have like Black Swan and Gray Swan events. Black Swan events are what's known as stuff that are not predictable. For example, COVID was a Black Swan event. You couldn't really predict that COVID was going to be as much of an impact on markets than it actually was going to happen, right? It's how the markets react when we saw this huge lockdown. That's a Black Swan event, something that's not predictable. A Gray Swan event is something that is potentially, or that could happen. Obviously, then you have probabilities of how likely is this Gray Swan event going to happen. But that's what the difference between a Black Swan event and a Gray Swan event is. So correct, that is correct. Bearish dollar if the dots do shift lower. So perfect. So let's just have a little look as to some Black Swan events. Now, this is something that I wanted to talk about here. This one on the left, the new Fed chair doesn't play by the basically rules, meaning the markets already know that Hassett is probably going to be dovish, meaning he wants to cut, which is very good for equities. So you might want to stay long ES, for example, stay short the dollar. But if he doesn't play by the rules, let's say he gets into power and then actually he doesn't want to be cutting as much, what do you think is going to happen to the dollar in that period? Strengthened by quite a lot. And that's why it is important, shall we say, to sort of think about what his viewpoints are. But for the time being, markets are going to want to trade what Hassett means for the dollar. Now, there's another one here that there is a possibility where there's UK leadership change. Now, basically, whatever his name is, the leader of the Labour Party, there's a possibility that he gets outed and then they reassess, the Labour government reassesses a new potential leader. And therefore, that can change the trajectory of fiscal. And the fiscal can impact the dollar. There's some other ones here as well. Like, for example, Germany overheats. Japan goes full Sane-omo. That's a Sane economics. Interesting. OPEC price war. There's some other things here, but the likelihood ones are right now UK leadership and potentially that one. That's more like second. Peace in Ukraine and Russia. That's going to be very good for the euro. We spoke about that last week. That can be also quite bad for Canadian dollar and the Norwegian krone because they export a lot of oil, and peace in Ukraine and Russia will bring oil prices lower. And therefore there's a tactical trade there, like short CAD, short NOK. So there is a lot of good, like potentially good trades for us next year. We just have to think which one is more likely to play out, and we trade that likelihood. So yeah, I just wanted to show us that. So that's what we want to be doing, right? On the Fed decision, they're likely to cut, so that's not going to move the dollar. It's about what the projections say, if there's anything in the statement, and then of course half an hour later we have Powell. What does he say? What is his anticipations? That is what's going to move the dollar, by the way. And of course equities for those who trade it. Gold as well. I know gold is kind of consolidating. And remember, we don't trade consolidation. We should never be trading consolidation. Always want to be in a trend. Now, anything else here that I want to be focused on? Employment change? Yes, I guess so. But employment change is the difference between full-time and part-time employment. And I think we did speak about this last week, about how part-time is a lot less of a true measure, because part-time you do generally switch jobs quite quickly in relation to full-time when compared against full-time, of course. So that's why sometimes you see really, really strong figures like this, but it's purely being driven by part-time. So it's not really a true measure. But employment change can give us a guidance. All you need to mostly be focusing on though is full-time. Unemployment rate, 4.4. I mean, it's actually still a lot better than a lot of people out there. So it should still be pretty good for that AED, especially if the Fed is really dovish tonight. That will be very, very good for that AED. Swissy as well. For those who like to trade the Swiss, the SMB is not really the main driver. The main driver right now is risk sentiment. So if risk sentiment continues to improve, the best way to look at it is look at ES. So if we look at ES, the best way to think about that is higher ES allows us to think that risk sentiment might get a bit better. And if we see potentially, hopefully, fingers crossed, of course, better things coming from Ukraine and Russia, Swiss is going to continue to weaken because it thrives in an environment of uncertainty. So if we start to see that there's more certainty coming back now, like better risk sentiment, less wars going on, the Swiss does not do very well. Does anybody then know? Now let's think about how a trader on a trading floor would think, basically. What currency would you pair the Swiss against to trade in that whole period? Chess, yes, Keir Starmer, that is the correct one. Powell says hello and the price goes down. True. Whatever, I mean, he is basically, whatever he says goes. I inspired from you to learn fundamentals in trading. That's good to hear. It's not easy, don't get me wrong, but remember, you have to do opposite to what the masses are doing. If everyone is just doing purely technicals, right? And not a lot of people are winning with technicals, then you have to figure out how do we find an edge in the market? And the edge for me was fundamentals. So just try and, it's not, like I said, it's not easy, obviously, but it is rewarding because it allows you to have a better gauge of where price should go in theory from a data perspective, right? Everyone talks about data, but nobody looks at data. So what we want to be doing is having a statistical edge in our trading as well. And that's what can create an okay trader, a break-even trader, to a great trader. And that's what we want to do. Plus, it's better for your mindset as well. You're no longer really guessing where price action is going to go. You're having some sort of edge in that. And that's what we want to be doing. How could this digital ID mandate affect the markets? I don't think it will affect it per se. That's a good question. I personally don't think it will affect markets because the way the markets work, right, is as follows. And I will type it out. The way the market works is we expect X, meaning, I don't know, dovish BOE. This then allows weaker pound, right? Weaker pound, potentially higher FTSE, although it's kind of been consolidating for a good few years now. But that's generally what happens. You might see stuff like a lot of bull steepening in the bond market, front end rates comes lower or yields come lower. That is very good for weaker pound. But if digital ID comes out and it then starts to affect this, which is the reason for this, then it becomes tradable. But if it doesn't and you see no impact, you're not going to see no impact in the pound. You're not going to see nobody trade it. So that's what we're more so focused on, is how would potentially that affect what is the main driver of the currency or the main driver of UK markets at that time. If it doesn't affect it, it's not tradable, is it? What is your opinion on the 100k static accounts on APEC? I'd have to Apex, sorry. I have to have a double check with it. But yeah, just let me know what you believe what's your questions about that, and I'll do my best to answer it. But how I have been approaching, because again, like I traded during a time, right, when prop trading never existed. So it's about, for me, it's about doing pretty much what I've been doing anyway, but just on a prop account. And that's what I've been doing. Like I said, I think it was either last week or the week before, about I'm testing out different prop firms to see what is best for higher time frame swings And if they're not great, I am going to tell you that, okay, this prop firm is not good for swing trading. If it's good for lower time frame, I will recommend it, but I can't recommend something until I test it out. So I've been testing out a lot of different prop firms, see which is best for swing and not for swing. I don't think we have to make for it so complicated. All we have to do is care about 10 pips a day. Possibly 10 pips a day, I guess, is possible. But obviously it then also comes down to risk management or risk to reward. So if you're trying to grab 10 pips and you need a 1 to 2, a 5 pip stop loss is so small. You got to think about it in relative terms. 5 pips, but you're risking 1%. How likely are you to constantly hit these 5% of these 5 pip stop losses before you hit a 10 pip move, right? You got to think about it in relative terms. So yes, I guess it is the correct way of thinking, but in actual aspect, it doesn't really work like that. Swing account. Yeah, okay. I've heard Alpha is pretty good. Alpha Capital for swing accounts. I know a couple of people who do that. They are on my list to test. But if they're not good, I am going to tell you they are not good. So, yeah, anyway, where was I before I started rambling on? The yen. So, yes, we'll talk about the yen as well. Now, unemployment claims. Unemployment claims, as we've spoken about before, it's not really a big driver. It's kind of within normal bounds anyway. 220K is pretty normal. It's not going to see too much. GDP for the UK is going to be important. And what I want us to focus more on is this one, which will be the 3-month average, which is right here. And this is what I want us to focus on, is the 3-month average, not the monthly, 3 months, because 3 months has more data. Exactly the same reason why higher time frame demand zones hold better than lower time frame demand zones, because it has more data in it. So 3-month average is what people are going to be looking at. And according to the forecasts, it's expected to remain pretty flat, which is not good. It means for that average of 3 months, it has done pretty poor and it's done no growth. It's not exactly a good sign, is it? And although the pound has done pretty okay in relation to a few weeks ago when we saw the budget, we know that this is not going to be good for growth in the future. So we know eventually we want to be selling the pound. It's just that all we need to do as a trader is think, when is the opportunity to enter the trade? And that comes down to data. So the more we see data, the more it tells us that we want to get into a sell on the pound. It's just not right now because we haven't had any data. Once we do, then it's opportunity. So yeah, 3-month average is the one we need to be focusing on for the pound, not the monthly. Monthly is too volatile. How long have you been trading? I've been doing for 7.5 years. So a long, long time. Prop firms came mostly around just after COVID. So yeah, before that, there was really no such thing as a prop firm. The only way to get a prop firm back then was to basically trade for a whole year, not make any money, or trade from a prop account anyway, have a 12-month trading record, and then they start feeding you little bits of money. It's not like nowadays where you pay, I don't know, 500 for a 100K account, obviously when there's discounts, which by the way, there is some discounts as you can see on the screen, and then you spend this little amount and then you can have access to whatever. Back then, it was extremely difficult to do it, and not a lot of people did it. Nobody that I knew at that time did it, because it was just, in our eyes, it was too long. I don't want to wait 6 to 12 months before I can get an account. So unfortunately, we had to use our own money. So yeah, but nowadays it is pretty decent to sort of get access to that. I wish it was something that happened when I first started. Example, in the previous high time frame demand area, but at present the market falls to same demand by looking at the present data compared to... I'm assuming, how do you access, or like how do you determine when to enter based on data? If you can tell me that, then I can show you how you should be doing it, or how I have been doing it. because it's not so much, right, entering when data comes out or entering if data does X. What you want to be doing is be thinking on a 1 to 3 month horizon and think, does this suggest weaker currency or longer currency or stronger currency in the future? Then you create the trade. You don't use like, oh, the data has to do this, it has to do that, and then I enter. Yes, it could work like that, but you have to be thinking, you use data as a confluence, then you wait for a breaker structure. That's how I do it. How do you learn fundamentals? It's a bit of trial and error, to be honest with you. A lot of the times, obviously I did use YouTube, but YouTube is very limited in terms of the ones that I was learning, because nobody really taught fundamentals, to be honest with you, and it was very, very difficult. And there's reasons why these guys who work on the trading floors, who are working at these hedge funds, they go to university to study economics or finance for years, right? 3-year course generally for a lot of these courses. Obviously, if you do masters, then it might be an extra 1 or 2 years. But they go to university to study all of this. So they already have a very good foundation on fundamentals or economics, right? That's all you're learning is economics. Then you can mold it to how you can trade it. Meaning, all you then think is, what does this mean for a trade idea? If you're an economist, you think completely different to how a trader thinks. If you're an investor, you think completely different to how a trader thinks, like one of us, right? Because they look at certain different types of data to determine value, whereas we will look at different other ones, but we all look at the same data. It's just that in terms of time frames, we look at it slightly differently. Like economists looks at it on like a good few years perspective. As a trader, you can't really do that. You have to be looking on a 1 to 3 month horizon. So nobody really taught that. So it's purely trial and error a lot of the time. 80% trial and error, 20% of mostly theory, i.e. learning what the terms are, etc. But then obviously a lot of the what's the word I'm looking for? A lot of your understanding mostly comes from applying it to live markets. It's all good knowing theory and what happened in the past. It's completely different to trading live markets, because then emotions come into play, context comes into play. If you don't think context, you are going to be destroyed. So yeah, it was a good few years. First prop, you had to make 10% a month to pass it. Yes, it was pretty crazy. And nowadays it's obviously a lot easier. But yes, back then it was pretty difficult. Do you have a lower time frame entry model? Of course, I'll show you. Now, how I like to trade when I enter is as follows. Remember, my whole premise of creating trades comes from data and comes from the Fed, or comes from the BOE, or come from like weather, for example, can determine trades because it then impacts oil, which like if it's through like Florida and southern Texas, impacts oil prices, which impacts CAD. So a lot of these can create trade ideas. All you're doing as a technical or on technicals is finding where is a rough good entry, where has there been value in the past, i.e. where has there been demand in the past, and how is your risk going to be? Meaning, if you put it below this low, you are risking 0.75 or 1%. If you put it below this low a little bit further, you're now risking 1.5%. I'm now targeting this, which then I might be getting, let's say, a 1 to 2 or a 1 to 3. Because at the end of the day, we want to be choosing quality over quantity. So here is how I would do it. So let's say, I don't know, I'm long euro dollar. What I'm going to be doing, right, is looking at only demand zones. Only demand zones, because I don't want to be selling when everything tells me to buy. So I want to be going where the probability state price action should be. And all of these pushes that you see, and then obviously you see nice moves and then choppy price action and then nice moves. All of this, right? All of, where's the box? All of this are driven for reasons. And every push that you ask and you see, and the pullbacks, by the way, they happen for reasons. That's why AUD USD, so far we haven't seen any major pullback because there's no reason for the pullback. That's why sometimes you see just one-sided, very short-term pullback because it's mostly profit taking. And then it continues to rally really aggressively because we haven't got a reason for a pullback. So always ask yourself, what is the reason for these push? I.e., was it because of ECB for this push? If it's a yes, perfect. Then the pullback happens on the high time frame, on like the 4 hour or the daily, and you see this pullback. Obviously, we only look for demand zones. So let's say there's a demand zone there. We ask ourselves, what is the reason? Put this over. What is the reason? And if it's something temporary, like for example, slightly better US data, then you know that's probably just going to be short term. It's not something that's now going to tell markets to sell euro dollar. Sell it in the short term, sure, but in the long term, no. So what you do then is you ask, okay, so we know that that is probably short term in your opinion. Then we mark out our demand zones, right? And then what you do, or what I like to do, is as follows. So we pull it into a demand zone, let's say right there. Then on a higher time frame. So I start on the daily and work my way down the time frames. Do I see any major areas of demand? If it lines up with a whole number, perfect. I don't know, let's say, obviously I'm in ES right now, but let's say this is euro dollar and this is 115. 115 lines up nicely with, let's say, that demand zone there. That's two confluences from technicals. Then what I want to do is then wait for price action to get into that zone, drop to the hourly time frame, wait for a break of structure. So for example, a break of structure here would be none of these, because this is the low, that's the high. Obviously it's a bit of a terrible example for this one because we haven't got interim lower highs, but because that's not a low, because we didn't close and below this low here, so therefore that's not a lower low, so therefore that can't be a lower high. This is just very simple price action. So let's say, I don't know, we saw a move like this and then a pullback there and then another move down there. That would be the lower high. And let's say this is in the demand zone like this. That would be the lower high right there. So what I will do is wait for price action to close above the high, and then I get in on the pullback, and then my stops will be below the high time frame low, and then I'm targeting a higher time frame high. So for example, let's say, I don't know, this was euro dollar. We'd first target the first high right there, and then we look to our left a bit further, and then we ask ourselves, okay, the next high is around 118, 120. Then we target 118, 120. And each time it trades higher, you're asking yourself exactly the same question here. What is the reason why we are seeing those pushes, and is it continuing? If it's a yes, you remain long. And that's how I do it. So yeah, that's just a very, very simplified way of doing it. That's something I've kind of molded over a good few amount of years now. I've traded every single strategy. Like I've done everything possible. It's just that I've always come back to simple just is a lot easier in terms of mindset, in terms of clarity, than having all of these concepts you try and mold together. And one says buy, one says sell, one says to not trade it. And then you become confused, and then you become doubtful, and then obviously mindset comes in. So if you just keep trades and markets very simple in terms of price action, it will be a lot easier on your mindset, that's for sure. Do you have any entry models? Pretty much that, really. It's nothing too special, to be honest. Do you have any trade ideas running? Yes. So last week we spoke about GA. Now GA is actually pulling back nicely. And here's a prime example, by the way, where we came into a high or a demand zone on the 4 hour, but have we seen a break of structure? Have we started to see structure being broken? If it's a no, we don't enter, we leave it alone. If it goes higher, big deal. Doesn't matter, we haven't entered because price action hasn't suggested it. So we're not in a loss, are we? So what do we then do? If let's say this continues to trade higher and we make another nice bullish candle right here. Obviously, that supply zone on the 4 hours now invalidated. Perfect. That's perfectly okay. It's all good. We haven't entered, so it's not that big of a deal. What do? We do exactly the same framework again and just think, okay, where is the next supply zone going to be met? If the pullback that we're seeing here right now, to me, is not warranted because there's no reason for these pullbacks to really continue on the high time frame, then I know I still want to remain short because, again, we saw like a hawkish RBA, right? Quite a hawkish RBA, if I must say. That should push AUD stronger over time, right? Over the next 1 to 2 months or so, until data suggests otherwise, essentially. So I know I want to be remaining long AUD. I know I want to probably short the pound, I guess against the AD right now, but we know the RBA or the BOE will probably want to cut by more because data is going to come lower because of what Reeves is doing with all of this fiscal stuff. It's going to drag growth, by the way. And if growth is dragged, yields come lower. And what happens to investor growth? It also comes lower. And the UK is very heavily reliant on growth and investors investing into the UK. If we're not seeing positive things, people are not going to invest. So we know we want to be selling GA. Then all we do is only supply zones. And you then just do the same framework again. Have we got another supply zone right here on the 6 hour? So we have a 6 hour supply zone there. And you do exactly the same framework. It trades into there, drop to the hourly. Do we see a breaker structure? Are we seeing structures being broken? If I say yes, we then wait for the pullback and then we get in. Stops can be wherever you really want to put it. I would prefer to have a wider stop just because to me, it's actually best to be in the trade than constantly be stopped out because I want to try and get this 1 to 10 crazy risk to reward. To me, that's just too unsustainable. So I'm happy to have a slightly wider stop, but my target is high time frame anyway. So it's going to balance out over time. And remember, over time is always going to come, meaning the future is always going to come. So don't just think so short term, think long term. And if you know in the long term, it would make sense and the data tells us that, then it will work. Now, sorry, where was I? So yeah, GA is actually the main one. NZD USD as well is also another good one to look at for at least until the 20th of January or the middle of January when we have New Zealand data. So that should run, NZD USD should continue to trade higher at least until the middle of January because of New Zealand data's out at that time. Yeah, once a week. I'm happy to do once a week at the moment. Could you recommend us fundamental analysis? I mean, I'll show you a book I have, but I don't know if it'll be quite useful. So, the two books that I have, or that I used, this is from 2022. So they're actually the CFA books. So right here, I don't know, because obviously the camera's being a little bit, this is the CFA one. Don't know if it will, there we go. CFA, Fixed Income Derivatives, Alternative Investments, Portfolio Management. That's quite a good book. You don't have to get the brand new ones. This one was pretty decent. And then the other one was this one, same year. This is 2022. Economic and Financial Statement Analysis. A lot of this probably won't be too much applicable to trading. But what it does do is it does broaden out the mindset in terms of how you think as, because at the end of the day, right, it's not that difficult to shift from an economist mindset to a trading mindset, meaning a lot of this is obviously a lot of theory, right? It's not that difficult to shift what this says in here or what you know from looking at the textbooks to then shifting it onto the charts. It's not that big of a change. All it takes, all these books, right? It teaches you theory. It doesn't teach you application. So the application really comes from actually being on the chart. So once you understand theory, perfect. You now have to put the work in the chart. So yeah, that's what I would recommend personally for myself. Or that's what I did, and that's what I would recommend. So yeah, that's what I do. What time frame would you look at for a breaker structure? 1 hour. generally around the 1 hour. You can look at the 30-minute, but let's be honest, you can gauge what the 1 hour is doing anyway by looking at 30 and vice versa. You can look at, you know what generally the 30 minutes are doing if you look at the hourly time frame. So as long as you just go lower than the original demand zone, so if it's like a, I don't know, 6 hours supply zone or demand zone, if you go down to the 2 hour or the 1 hour, that should be okay. What's the current situation on gold? That is a good question. I marked out gold. I know we have consolidated for a bit, which is right here. I mean, I'd rather be long gold than short it, because if we show these guys over here, and yields have actually kind of popped recently, which is okay, but as a trader, you have to think about the future, right? So if you know the future is looking more so like the Fed is probably going to cut by more, then yields should come lower. As a result, what happens is gold is inverse to that generally, especially if inflation also comes lower. That is quite good as well, because it allows lower yields as well. Gold does pretty well in that environment. The only thing I am a little bit cautious of is the fact that there is stronger S&P, and a stronger S&P is not good for gold, because gold thrives in an environment where there's not that much risk frothing around. So yeah, I would be more so inclined for longs for the time being, though. I don't think the S&P is the main driver of gold right now. Session models, I don't trade those sort of models, to be honest with you. Yeah, I just don't trade those sort of models. Trading show for how to read fundamental economics. I could try and help you. Trading show for how to read economics. I'm assuming you mean like a video. If you could just clarify that. But remember, a lot of this stuff, right? A lot of these economics, a lot of this fundamentals, a lot of it is going to come down to what you want to do at the end of the day. It's kind of like anything in trading, really, where you're only going to see success if you actually put the work in. A lot of people are just lazy, right? A lot of people are not going to want to do it. And those people are not going to do well in trading. No matter how much they believe, they will not do well because they are not willing to put the work in. They think that just scraping by is going to be okay. But unfortunately, trading rewards those who put the work in. Especially if you can broaden out the mindset in terms of learning more stuff, it helps you even better. Because you never know, one day you might look at something and it helps you out. So if it helps you out, that thing you did in the past is no longer seen as a waste of time. So a lot of people, yeah, like I said, a lot of people are not going to do well because they're just not willing to put the work in. So I hope everybody here is willing to put the work in, but it's not so much of, I'm just going to do it every now and again. You need to create like a schedule. And that's kind of, obviously I started during COVID, so it's a bit of a different scenario because everybody had a lot of time. But nowadays it's probably best to create some sort of schedule. Finally, GJ, yes, GJ is actually a good one. GJ is kind of trading higher for the time being, which is perfectly okay. It's mostly being driven by two things, which is UK optimism on the back of the budget in terms of it's not as bad. We spoke about that about 2 weeks ago when the budget came out. But we know the future in the UK is not going to be good. So we know we want to be selling pound, but just not right now. The yen, though, is kind of stagnant for the time being, which is a bit unfortunate. And I think it's mostly being driven by higher yields on the US, which drags the yen lower as well. I don't know if I can put dollar yen on here as well. It might be good. If I show you this, let me get up dollar yen. And then this one, I think I have it on here. So this is what's known as rate or interest rate differentials, or yield differentials as they're referred to. Basically, this is the spread between the US 10-year and the Japanese 10-year. Now, Japan, does anybody know why Japan is so sensitive to the bond market in the US? Does anybody know why that's the case? Obviously, this is divergence. where dollar yen goes higher and the spread is actually going lower, technically dollar yen should be at 140.3 right now, but it's at 156. So you have to ask yourself is why has this diverged? And this is actually mostly on the Japanese economics front. So if that's the case, and we start to see that things change, like we are starting to see, then we know the yen should strengthen in the future because it's battling the whole reason it's weakened in the first place, or the yen has weakened. But yeah. We'll do the giveaway in just a moment. To enter the giveaway, as you know, type !join. I just remembered the giveaway. Do this and it will be entered into the giveaway. And we'll open it up for about 10 minutes or so. Yeah, that's already max. If you enter that, that will put you into the giveaway. But yeah, let me see if there's anything else here. I'm new here. What's your strategy? Higher time frame, fundamentals. Pretty much when people say trade like the banks, if this is what the banks are doing, why are we not doing it? That's kind of what I'm aiming to teach. If these big guys are looking at everything else we've discussed today, why are we not doing that as well? That's the question I asked myself when I was first learning. That everyone says, you know, we want to follow what these big whales are doing, but if we're not doing what they're doing, how are we going to follow them? You see what I'm saying? That was the question that sort of I went through. Can you explain a bit more details on market supply and demand? Is it like order blocks? I guess so. Look, all these strategies, right? They all are pretty much the same, just worded differently, right? So demand zones, order blocks, I don't know what other ones are out there right now, but those are the main two. They're pretty much the same thing. Areas of demand, stuff like this. People would say that that is kind of like an order block, which is also true. It's exactly the same way. Like people say, market structure shift and breaker structure. It's the same thing, just literally worded differently. So yeah, they're all the same at the end of the day. But remember, direction comes from fundamentals. So if you can position accordingly to direction, then you should do pretty well in trading. Yes. So that is a good thing there. Mine shuffles a lot when comparing data for multiple currency pairs. I taught this for some of my mentees, and I'll show you how I do it. This is how you should be doing it. What is the theme? So you ask yourself, what is the theme? i.e., what is everyone talking about? About, question mark. So if everyone's talking about the Fed or wars or whatever, data / speeches, of course, will be minimalized. Minimalized. I think I spelled that wrong, haven't I? Probably. But anyway, minimalized, meaning only a couple of bits of data is going to be important. Because if people are only talking about the Fed or the central bank, all you do is you only look at data that applies to that theme. Everything else does not matter. Everything else is noise and BS. You only look at data that applies to what the theme is. So if it's about the Fed, or if it's about wars, or if it's about something else, data that only applies to that is going to be important. So therefore, instead of looking at everything, you look at only a couple of things, and then you compare it against somebody else, and that is it. That's how I had to learn that the hard way, unfortunately. Let me see. And we'll look at some views from other banks as well. As you know, I always like to show other views. Because Japan buys US bonds, that is correct. Yes, that's the one I'm looking for. It's because of when yields come lower, right? So if yields come lower, price of the bond tends to rise, right? In theory, price of the bond rises. So if yields like this on the 10-year comes lower, That's basically meaning, by the way, if you buy a government bond on the 10-year, you're earning 4.16% every year for the next 10 years because you bought a 10-year treasury bond. So regardless if yields come all the way down to 0%, you're still earning 4.16 because you bought it at that time. However, what happens, right, is when yields come lower, prices have to rise because what he wants to do is become more expensive. What do I mean by that? It's like simple supply and demand, right? A government does not want to offer out a crazy amount of yield for a very, very, very high price. So it's like supply and demand. So if they see that, not many people are buying it, so let's increase the yield to, let's say, 4.3%. Prices obviously fall to basically entice people. So people buy it, and as people buy it and more demand comes through, the price of the bond rises because, again, demand. The yield has to come lower because the the government or the company, because companies also have bonds, by the way, that they issue out, no longer see it as applicable to offer at that price, and then it has to come lower, and it's like simple supply and demand. So as this comes lower, the yield comes lower, the price of the bond rallies, doesn't it, and goes higher. What does that mean? The balance sheet in Japan increases, so they seem as more attractive, and that's why the yen is then seen as more attractive as well. If trading had no money involved, no payouts, no profits, would you still trade? Probably not, I'll be honest. Look, you got to enjoy this stuff. This is something that you can't just do as like a side hustle. You have to actually enjoy trading, or you have to actually enjoy wanting to be in the markets. If you don't enjoy it, I don't get why people want to do it, because it's just not going to have much substance in the future. Like, you're not going to have that want and that want to do it. So you have to, trading is just one of those things where you actually have to enjoy it, rather than just doing it because you see that the money is okay. But realistically, the probabilities of that, of you actually becoming very, very good in trading is quite slim. So you have to want that drive to push through that probability of being successful. So yeah, it's just one of those things. But I guess I'd have to find another market to do it, really, where there is money. I think I saw another. What time frame do you trade based on fundamentals? Higher time frame. So daily, 4 hour. Basically, if I buy here, for example, I'm only then going to trade it to the next higher. So if that takes a month, if it takes 3 weeks, if it takes 2 months, I'm still going to hold it. But remember, we don't just enter once. Like, let's say we enter there and it goes higher. Perfect. But as these pullbacks happen, you can always load up another long. Obviously, what you can do is you take partials on the initial swing. You now have margin to play with, and then you have another swing in there. So you don't have to just enter once. That's quite a common misconception about swing trading, is you only enter once and then that's it. So you can enter multiple times, obviously, as long as you're within risk management. So if you take partials out, now you have better risk to play with in terms of margin. But yeah, let's just do the giveaway. So I'll stop it there now. Random name generator, wasn't it this one? Yeah. So that's from the last session, last week. So we'll delete that. And let me just copy this list that I have, which is over there. So for now, what we have is, let me just see. We have as follows: Apex, funding next, and a 3-month trades out there. So firstly, we'll do Apex. So obviously, as I'm sure you are aware now, the way it works is we'll spin the wheel. Somebody's name comes up. I'll give you about 30 seconds to a minute, because obviously there's a delay between what I say, and like a stream delay, I guess. And then you have to say in the YouTube chat that you are here. If we don't see you within 30 seconds or a minute, unfortunately, we'll have to remove you and move on to the next person. So you must do that. In addition, once you do that, and once you're confirmed that you're here, you then open a ticket within Discord within 24 hours. Then we'll obviously get some details, and then obviously your account will be issued accordingly. So that's generally what happens. So let's start off with the what is it? Apex account. The size of the account, I'm not too sure. You'd have to speak to one of the mods, and then they'll give you the account size once you open a ticket. So let's spin, and we'll see. And then I'll answer some questions. So remember, you have to say that you're here. Carry trade in Japan, that is correct. That is the overnight interest rates. That's mostly on carry. So this person, Lazet Makawowski, 4429. If you're here, please let me know. Just say in the chat that I'm here. We'll remove you. If not, also, if you are here, we'll remove you and then spin for the next person. But I'll give you about 30 seconds to a minute. Commodity currencies like Australia exports iron. That is correct. Should we consider that? Yes, only if that is the main driver. Meaning, everybody right now is talking about the RBA. So you can't really just look at... Let me just see if this camera's going to focus. There we go. You can't just say that, oh, I'm going to look at iron ore for my understanding where AED is going to go. If nobody's looking at it, that's the thing. If people are looking at it, perfect. That could be a very good confluence, but nobody is. And I see that you're here. Correct. Perfect. Amazing. So let me just double check the name. Yes, that seems good. So you're here. Congrats. That's for an Apex account. So you must open a ticket within Discord within 24 hours. So yeah, well done. Let's move on to the funded next account. So yeah, to answer your question, only if markets care about it, which I believe right now they don't. So you can't say that iron ore higher prices, or even if iron ore is coming lower, you have to sell the AUD. It's only if people are focused on this aspect, which right now they're not. But yeah, in the future, possibly, that would be a very, very good one to look at for sure. SP King, S5Q. If you are here, let me know in the Discord, in the YouTube chat, and we'll see. If there's anything else, let me see. If there's any other questions, please let me know. What are some good fundamental events that can predict long-term PA? Fed meetings like today, BOE meetings, stuff like NFP as well, like big impact, because the reason this stuff has high impact, right, is because it changes the idea of the market, meaning it has an impact on what the Fed can do. If the Fed sees a really terrible NFP print, they are probably going to consider it. As a result, markets might shift their view. So big stuff like this is going to impact the price action in the future. So mostly Fed events or central bank events. And then if they say something about, we are watching this set of data, and that data set comes in, let's say, a lot worse than expected, you now think that in the future, they are going to be a lot more dovish. And that's where the trade is coming from. Obviously, certain events like what we looked at before, which is this one, Grey Swan events, Black Swan events, obviously that has things to do. But generally, it'll be central bank meetings that moves it. So yes, I see you're here. Perfect. Let's move on to the next one. So this is from for a trade 3-month trade Zeller. Let me double check if there's any other ones. Where do you get your data from, since US data is freely available online, but other countries not so much? Hamza X3S 4V, if you're here, let me know. But I'll quickly show you where so this person, you must say in the chat. I'll give you 30 seconds to a minute or so. But you go, Trading Economics is a good website. The link is just tradingeconomics.com. And the thing is about these websites, right? Like, it's all good having all of this data, but not a lot of it is tradable. Meaning, you don't, like, when I was learning fundamentals, right, I thought that I had to look at everything. So I had to go through, let's say, the US data. US data is actually very, very readily available, which is amazing. But other countries out there, not so much. A bit unfortunate, but it is what it is. But I used to think that I had to look for all of this bits of data. What does this mean? What is labor cost doing? What is productivity? Blah, blah, blah. What is money supply, M2 money supply? Obviously, this is more central bank levers that they pull in monetary policy. But I used to think that I had to look at all of this, and you don't actually have to do that. So, Hamza, you're here. Perfect. So, yes, that is it, everybody. But yeah, to answer the question, you don't have to look at everything. Only a specific amount of data is going to be important. Like what we spoke about before, if certain things are driving currencies, you only look at data that drives that theme. If it's central bank, you only look at CPI, NFP, unemployment rate, PMI data, because it can give us a bit of a guidance on the future because it's forward looking. Possibly retail sales. You see how it's not like a lot of data to look at? So that's kind of that's all you focus on, really. What's your favorite exotic pairs? That is a good question. I used to be a big trader back in the day anyway of the ZAR, which is obviously the South African rand, ZAR. The Mexican peso is actually also pretty good. USD ZAR, GBP ZAR, which was another good one. Obviously, I went to Cape Town in February 2025, Jan-Feb time. So yeah, right back then it was about 23 rands to the pound. Now it's dropped. I know if you look at Turkish lira, obviously I don't trade that, but I know Turkish lira, right? Back in the day, it used to be quite weak. Back when I went, which was like 2012 or something, it was around 2.8 Turkish lira per pound. Now it's at 56 lira per pound, but obviously because of price adjusted inflation, if I know in Turkey at the moment, a lot of things are quite expensive. So even though the price has risen or you're getting more bang for your buck, in theory, the purchasing power is actually not really changed. But yeah, this stuff is all driven by reasoning, not because of price action. Price action is a product of reasoning, of the reason why it's happened. So if you can have a good understanding as to why something has happened, then you can have a good understanding of or what is expected to happen. You can have a good understanding of where price action should be in the future. And that's what you're doing as a fundamental trader. So, are there any other questions? Let's double check. Your bias by fundamentals, how is it going to affect the dollar for the next 1 to 3 months? Correct. How do you deal with shorter term, 1 to 2 weeks, with where price action may move in opposite to your place? That is a good question. So, the way you do it is as follows. Go on the hourly or whatever. It doesn't really matter what time frame, to be honest with you. Just go on that time frame. And let's say we're seeing this pullback for the week. Let's say we see USD Turkish lira or GBP Turkish lira come lower. We ask yourself, what is the reason why it's come lower? There's going to be a reason, right? These pullbacks that we see on the this is the 12-hour time frame. So there's reasoning as to why it traded from there all the way down there. Maybe something in Turkey happened that was quite good. Turkish lira strengthened. But what you notice is that it didn't change the overall reasoning as to why the currency is so strong or this currency pair is so high in the first place. So what you ask is, why is the pullback happening? It could be data, could be the Fed, the BOE, could be the Turkish government, whatever it is. If you're trading GBP TRY, of course, if you're trading GEU, the same scenario. Is it because of the Fed? Is it because of the BOE? Is it because of data? But if you then ask yourself, in your opinion, because remember, at the end of the day, it's your opinion, that this is not going to be a long-term thing, then you know that the pullback is going to switch. How do you know when it's going to switch? It's a bit difficult to predict, but what you can do is see if data comes in positive and then notice if a breaker structure occurs. So for example, if we get a pullback here, right, and we pull back into this daily demand zone right here, and we're selling off, we're selling off, we're selling off. We constantly ask ourselves on the pullback, what is the reason why it's happening? So we pull back, we pull back, we pull back. We ask ourselves, why is it happening? And if you believe it's something that's not basically game changing in terms of the trend, you know that it's going to do something like this, where it pulls back and then continues the trend, pulls back, then continues the trend. Pause back here, but continued the trend, right? But if you then go back in history and look at what happened during there, you'd probably think that it's not really that big of a deal in relation to why was it trading higher in the first place. And if it's not, you do exactly the same framework. You wait for a break of structure, wait for a pullback, because we need price action to slowly turn in our favor. And then a pullback stops below, let's say the low, for example, go on the high time frame, then look to your left and see if there's a high. If there's a high like there, then you target this first high there. That's how you do it. So yeah, it's not so much like 1 to 2 weeks. It's asking what is the reason why this pullback happened. That's what I tend to do. Context is obviously very important. Toughest challenges faced whilst you learning fundamentals. To be honest with you, is the application. Like, everybody can learn the theory, right? What is monetary policy? What is inflation? What is employment data? What is PMI data? Like, this is all theory that you can learn. But it's the application that at the end of the day is the most difficult. It's thinking in terms of live context. That is what builds you as a fundamental trader. It's the live context trading. Not so much, this is what's happened in the past. This is what happened during the financial crisis. This is what happened during COVID. That's all theory. But how we trade it in live markets is really a lot different. So I'd say that's the most difficult thing, is thinking in terms of context. The current theme of the market is central banks. So the way to trade that then is compare. This is when the terms come in. So I'm going to talk about in terms of terms. Dovish versus hawkish. Or other way around, hawkish versus dovish. Doesn't really matter. You want to be buying hawkish, selling dovish. So for example, if the Fed is dovish today, basically you want to be selling USD. Then you want to be buying hawkish. So basically who's hawkish right now is the RBNZ, the RBA, the ECB, I'm going to say short-term yen because we do have the BOJ, I believe, next week, if I remember correctly. So that's all you do. So what does that mean in terms of price action? Basically, in the future, then you're now anticipating AUD USD to be higher, NZD USD to be higher, Euro dollar to be higher, and then I say short term, possibly dollar yen to be lower, but obviously BOJ is next week, I think, or the week after. Either way, that's all you're doing. And once you enter, you can use whatever technicals you want to do. It doesn't really matter at the end of the day. Every technical's work to their own degree. All you need to do is get in at a decent risk to reward and then get in. That's it. And then hold the trade. So yeah, that's what I would recommend doing. Gold wise, it is consolidating. So we're going to have to see what the Fed says today. Once we see what the Fed says, then we can have an understanding. But if they're quite dovish, fingers crossed, then obviously, yes, gold should continue to pop. Any tips on the first quarter? It's a bit difficult to think about what's going to happen in the first quarter because a lot of things are going to change quite quickly, which is why you hold a view, like let's say I am anticipating AUD USD to go higher. But then when you see something change very quickly, let's say in February, that's obviously now going to completely switch that trade to the downside. So I'm thinking every week is something changing. If it's not changing, you still hold that view. So for Q1, it'll be interesting. I think in terms of history, the dollar does tend to do pretty well after the start of the year. But obviously it depends on the context as well. So we're going to have to see. I couldn't really say what could be a good thing. All I'm thinking about is my reasoning changing as of this week? If it's not, I still hold that view. I have a question. What's your view on euro dollar? Let's say the scenario is Fed cuts, but there are members of the community who were against. How would you be going about positioning yourself for euro dollar? Good question. So the way I would do it is ask myself, if the Fed wants to only cut by 1, what is the reason that they anticipate that? And in addition, how does Powell emphasize this during the speech, because the markets will ask him, or he will get questioned during the speech, why is it you only anticipate one? Because of labor market data is weakening off. NFP is expected to come in quite poor in the future. If he doesn't give the markets a good enough view of that, the markets are going to trade above one rate cut, meaning that even though, let's say, the Fed is only expecting one rate cut, according to the dots or the Fed members, but the markets see that as quite unlikely, they're going to overprice it and say, actually, we expect two. But then let's say it comes to March time, the dot plot can then shift to two. So what you're thinking about is, obviously, number one, what does the Fed say? Do they expect one? Do they expect two? And does the market believe that? And the markets are going to trade what they believe. They're not going to think, oh, the Fed expects this, we have to trade it. If they don't believe that that's going to happen, they are going to trade more rate cuts, which is bearish for the dollar. View on CAD. That's a good question. I would personally, I'll leave it alone for the time being. I need to think about that for probably a little bit longer, because I want to see what the Fed does today, and I believe we have Canadian data on Friday. Oh no, it wasn't Friday. It was next. Was it next Friday? Where is it? Oh, I saw some Canadian data. CPI. So yeah, I want to see what CPI does next Monday, and then decide, and then I'll have a view on that. Do I scalp? No. Or day trade? No. CFA level 1 is enough. Yes. If you're doing CFA, you probably want to do all of them, because CFA is one of those things that would be quite useful for you if you want to work in the banking sector. If you want to work for like a bank, they will be quite favorable for you if you do have some sort of CFA. So you have to have all three to be certified. Having fundamental idea correctly, do you run into bullish bearish squeezes? Sometimes, yeah. That's only if positioning data is against it, or not against it, sorry, but too stretched in one direction. So like, let's say, I don't know if I can look at COT data right now, because it has been kind of delayed. Where is it? Over here. But let's say, I don't know, we look at COT data over here, and then we will have a little look at the long positioning. And then let me double check shorts as well. So right now, short positioning on the yen in terms of leveraged money, which is hedge funds, by the way, are quite high in relation to previous highs. In addition, asset managers meaning more like banks, for example, and non-reps is more like retail traders. So a lot of it is kind of squeezed to the upside in terms of shorts. People are adding more and more and more shorts. That then and basically tells us that price action may struggle to continue to trade higher, even though fundamentals would suggest to go higher for the time being. But then eventually that is going to pop. And there's only going to be a pop when a reason comes through. So I'm also interested in what is the reason that comes through that allows the short squeeze to happen. So that's what I'm also focused on. What is the reason I'm going to be in a short? Because right now, yeah, it's kind of understandable why dollar yen is pushed a bit higher. But if something comes through, we can't ignore it. So yes, I'm not so much focused on that. I'm more so focused on the data. But if positioning does remain continuously stretched, it does tell me that it will reverse soon. It's just a matter of when. And the when comes from data. Let me double check. How can you train yourself to create trade ideas from context? Context is just something you just pick up as you go along. Basically, you just have to be in the market always, or like always keeping up to date with what's happening. If you know, let's say, a good way of thinking about it is, if the context is right now that The US is seeing worse labor market data, but the Fed is not wanting to cut further and further. So we know the context is weak labor market, or the markets see that, okay, the context right now is the labor market's weakening, but the Fed doesn't want to cut. But then suddenly something comes through that allows the context to play out, meaning we see a very dovish Fed member, or we see a very bad print. Markets are then going to jump on board that and overly play the hand from the Fed. So with context, you just have to think like you just kind of have to be up to date with everything to understand context. So it's more so understanding what's happening right now, and is the things we're seeing challenging the context or not? That's the question you're asking. So it's a bit difficult to explain right now because a lot of things are happening, but you do kind of pick up with things that are happening the more you are up to date with stuff. How do you do, or what do you do when you deem your bias being wrong? The only reason I change my bias is when data tells me to change it. So there are periods, right? Don't get me wrong, where I might be, let's say, long euro dollar. It comes to a demand zone. I see a nice breaker structure, and then it goes up, but it hits the supply zone and comes down, and then it goes for a loss. Cool. It is what it is. But if I'm seeing nothing for a reason why it should shift in the higher time frame, I know that's probably then just a bit of a deeper pullback. I'm then gonna ask, why did it trade lower during that leg? Meaning something like this. Like, let's say we come to the highs, we then break, and then look, or we see a breaker structure into a demand zone there, and then we come and I try and wait, I'm just trying to see how I can draw this out. So euro dollar's trading lower. It then comes to a demand zone. We then buy once we see a breaker structure. So that nice breaker structure, close above the high. We then buy, or like we hit supply zone. We see something like this. But then I think that's a breaker structure, and I buy up at demand zone. It goes higher and then it drops lower like that. Or maybe not as aggressively, but you can get my gist, where we just kind of come into the demand zone and then we come lower like that. And then we create a new leg. Every time I'm asking, what is the reason why that happened? And there is going to be a reason. So if the reason is something temporary, then I know, okay, that's fine. It's then going to come to another demand zone slightly lower, let's say down there. And then I'll do the same framework. But if I continuously take losses, I have to reassess and think, why is markets really trading lower? Is there something I'm missing out? And if I'm like, actually, yeah, I got it wrong, so I took unnecessary losses, maybe because I wasn't looking at this set of data or I was ignoring it, I'll try and use that as a lesson. I think, okay, right in the future now, I have to be thinking about this. Or I wasn't really thinking too much in terms of context, or markets were so overly one-sided on fixated on one set of data, but then suddenly they were ignoring the other signs that were coming from the other bits of data. So it was getting too overly optimistic. So that's what I'm always asking, is what's the reason we do see sell-offs in periods of when it should hit a demand zone? And if it's nothing major, you see a reversal. But if it is, then that's probably when it's best to shift your bias. I don't trade liquidity, sorry. What are you trading trades at the moment? I am a GA, NU, Eurodollar. What's the other ones I'm looking at? I'm waiting for dollar yen. We did actually see a reaction out of dollar yen from the high. I think I must have deleted my technicals, but we did see a reaction, unless I'm looking at another one. No, but we saw a reaction from the high here, which was a 12-hour supply zone right here. And it lines up with around 157 hole, so close to 157 hole right there. So that's kind of okay, quite a nice area. And then I'm seeing a breaker structure, not right now. The breaker structure is going to occur right here. So if you see a closure below that low, that's good. Remember, pullbacks are always going to happen. And then I'll get in on the pullback. So hopefully something comes through today from the Fed that creates breaker structure, and then we will get in on the pullback. At what point did you decide? I traded during uni, to be honest, so it's kind of a bit different. So in uni, obviously, I had a lot of time anyway. So it's kind of it doesn't really work like that for me, unfortunately. But for a lot of people that I know that were working full time to then want to do this, the thing that I noticed was that it started to replace the income that they had in said work, i.e. they were kind of matching or maybe making a little bit more from working. They continued to work there for a bit longer because obviously you want some sort of buffer in that period. And then it obviously got to a point where they're actually doing pretty well, and it's probably best to go all in, especially when you're young, right? I'm young, but obviously I'm a little bit older now. But I know, I wish anyway, when you were younger, probably take a bit more risk than you would normally, because you're young and you've got a lot of things to do or to learn anyway in the future, and you have the opportunity to take a lot of risk when you're young. So that's what I wish I did. Do I trade fixed income? No, I use it as a confluence factor. You can't really trade fixed income for like in normal retail brokers, but you use it in conjunction with directional bias. On the 3-month, dollar yen has touched resistance. Yes, you would definitely use that as an area of interest for sure. I don't know. Let me look on the 3-month to weekly. Yeah, we have kind of tapped towards the high there. We tapped 157 over here. Yeah, all looks pretty good. I would agree with that. Being a fundamental trader, what is your trading/year ratio? Good question. I'm not so much of a person who really cares too much about, I need to enter one trade for 1 week, or I now need to enter a trade because I haven't done so for a month, for example, or 2 weeks. I only trade when I see an opportunity. Like, this is a very common misconception that a lot of people have, especially when you're learning, right? Is you feel like you need to be in a trade, and you don't have to be always in a trade. If there is no opportunity, even if you don't trade fundamentals, if you don't see an opportunity in markets, don't trade it. And obviously you can do different ways. Like, for example, you can not have MetaTrader on your phone, so you're not always looking at your trade that you're in, or you don't have TradingView open on your phone, or you don't have the app, so you don't always feel like, oh, let me quickly check TradingView, see if there's something popping up. Only use it on like a laptop, for example. So there are ways to prevent over trading, but a lot of it does come from mindset that I noticed, where you feel like you should overtrade because you want to make money, but it actually works opposite to that, where the more you trade, the more likely you are to lose a trade. So therefore it's counterproductive. So think more about quality. Does this have a lot of confluence? If it does, take the trade. If it doesn't, don't enter. But apart from that, I think that's myself for today. We'll follow up on the last questions. But yeah, I appreciate you for being here. Unfortunately, we won't be on for the Fed meeting, but we just apply the same framework from what we've spoken about. The reason the dollar is, let's say, so strong for a while now, or has been strong, we've seen a bit of a pullback now, but has been strong during these periods, is because of hawkish Fed. Cool. Is that starting to change? And if we are, like today, are we seeing a dovish Fed? If it's a yes, then we know that these pushes that we've seen should continue. How do you then target? Well, as you know, if you sell, you target lows. So if you sell, you target the first low there, and then probably around 97,500 to then all the way down to the lows at 96,500. Firstly, you'll probably target the first low. Then ask yourself, does it still make sense? If it's a yes, target the next low. Does it still make sense? Yes, target the next low. And that's all you're doing. It's not so much trying to predict that, oh, I'm now going to sell the DXY from here all the way down here. It's not realistic, let's be honest. It's more so just keeping up to date with everything that's going on and just constantly asking yourself, does this trade make sense or not? And that's how you build confidence in trades, basically. Can you help identify supply and demand zones on the 1 hour? Sure. I used to trade the 1 hour back in like 2018, but I'll show you how I would do it. So for example, like right now, right, this is the lower high on euro dollar, by the way. We've reacted from this demand zone that we spoke about last week. We've now started, if we can close above that, perfect. That's a breaker structure. But you can see how this lower high created the lower low. We closed below the low there. Perfect. So that's the lower high. have we closed above this lower high yet? No. So it's not a break of structure. Once we close above the high, then it is a break of structure. What I'll then do is something like this, where fundamentals tells me to go long, technicals are telling me to go long. Perfect. That's two very big confluences. So there's 1 hour demand zone right there. I'll then start sort of going down, like 3, 2, 1, and then 45-minute, and then 30-minute maximum at the moment for sort of when I go down, or yeah. And then minimum or maximum, one of them. Maximum down time frame I'll go down to would be about the 30-minute, just to find an area to buy from. My stops anyway is going to be below the high time frame low, because I'm targeting higher time frame highs. You're not trying to catch these 1 to 30 trades, because that is not realistic. You want to be catching these sort of 1 to 3s, 1 to 4s, 1 to 5s, sometimes more than that. 1 to 10s sometimes, not always though. But you want to be in these trades where you're not always second guessing direction. That comes from data. That doesn't come from, no matter how good your mindset is going to be, you need to have a statistical edge. And that comes from understanding fundamentals and understanding data. It sounds boring, but unfortunately, it is what it is. So apart from that, everybody, I'll let you be. Yeah, we'll see what the Fed says today. We'll discuss it again next week. But that's all we do really on how we apply fundamentals. GA, on the GA trade, what was the driver that made you pull the trigger? RBA a couple of weeks ago. Or when the RBA was quite hawkish, because that then created AUD strength. It's not like you have to wait for a trigger. You have to think about it in terms of what have we seen, and does that still continue to tell us in the direction? We saw the RBA be quite hawkish a while ago. That's allowed the AUD to remain quite strong for a while. All you do then is you ask yourself every week, is this changing? And it hasn't. It's actually gone more in favor recently, especially this week. So we remain long AUD, i.e. we still remain short GA. So you only still then look for supply zones. Nothing's telling us to buy it yet, so we don't buy it. But yeah, apart from that, everybody, I'll have a good rest of your day. And I will see you next week, everybody. Take care. Appreciate you all for being here.